So in this second part of the morning, we're going to hear from Matt McDonald on the assessment template that is included in the staff report and hear how staff is requesting that it be used. And then we're going to move into breakout groups for the remainder of the morning to start to consider how these existing mechanisms support a subset of outcomes. But I'll turn it over to Matt for this discussion.
Thank you, Dan. And thank you and welcome, everyone. For those of you who don't know, my name is Matt McDonald, a Commission Counsel here with the Hawaii Public Utilities Commission. And this presentation serves as a brief summary of Section 5 of the second staff report, copies of which should be located at the tables you're sitting at. So feel free to reference that during and after this presentation. And at a risk of belaboring the point, I'm just going to once more, I hope you'll indulge me, just kind of check in as to where we are in the phase one of this process. So phase one of the PBR proceeding revolves around three primary steps, three major steps. Each step encompasses both a technical workshop as well as the filing of related briefs from the parties afterwards. Of course, as most all of you know, is because most all of you were attending there, the first workshop was focused around goals and outcomes and beginning to formulate a goals outcomes structure that can begin to serve as a lens by which we look at our existing regulatory framework. And now we're moving into step two. And step two we've characterized as a regulatory assessment. So we're looking to examine the current framework and look at the individual mechanisms of that framework and look at them specifically as to how they may drive achievement of specific regulatory outcomes that we discussed last time. So the goal of this effort is to sort of inform the development of a distilled and focused list of regulatory outcomes that will be further addressed in phase one, of course, as we move into step three of this process. And we'll begin to dig in even further as we move into phase two of this proceeding. In furtherance of this effort, so to help support the parties as they prepare their briefs, as they think about conducting a regulatory assessment, staff has put forth and offered a kind of common structure or methodology to conduct a high-level qualitative assessment of the existing framework. And so this assessment template looks to do a few things. It looks to serve as a simple format for capturing observations about what might be working, what might not be working in the view of the particular party conducting the assessment. It seeks to describe how specific mechanisms may impact identified outcomes. And it also seeks to highlight interdependencies and trade-offs between outcomes and mechanisms. And finally, it should help to support and serve as a platform to incorporate data as a reference point for discussion. So Dave mentioned this a little bit at the top. You know, as folks are assessing this existing regulatory framework, as parties are offering conclusions about what might be working, what might not be working, to the extent that the parties can cite to quantitative data or other you know, evidence-based approaches to support those conclusions. I think that's what we're trying to encourage here. So with that, I would like to just briefly step through some of the kind of you know, steps as to how one might utilize this template, this simple matrix. So here we have it. It's also attached to the staff report as attachment A. Here's the first step of kind of this reference guide as to how one might utilize what we're calling an assessment template. The first step would be to identify the particular regulatory outcome that you're looking at, you're examining. And let's see if I can get it. Well, the pointer doesn't work on the screen here. So, you know, if you begin at the top line here, the party would be asked to identify the specific outcome to be assessed and, you know, map that to the overarching regulatory goal that outcome would fall underneath, consistent with the sort of goals outcomes hierarchy that we've established earlier on in this process. Now, as Dave clarified earlier, these outcomes can be drawn from staff's suggested potential list of regulatory outcomes. It can be from outside of that list. But what we're asking parties to do is essentially select 5 of the top priority outcomes for that individual party to conduct this exercise with. So let's just briefly walk through how one might do this for a single outcome. So the outcomes identified, it's mapped to the specific regulatory goal, and a brief description of that outcome should be given. One should feel free to utilize, if it is a goal, or if it is an outcome rather, that is drawn from the suggested potential list of outcomes that staff has put forth. One will find in attachment B to the staff report a list of those outcomes along with descriptions. So feel free to use that description if it makes sense for you. Feel free to modify that if you think that it needs to be reframed. And then, importantly, the assessment template poses the question, for each mechanism, does the existing regulatory mechanism sufficiently support the outcome we're looking at? And there's a choice of 3 answers to that question. The first would be yes, the mechanism incents achievement of this outcome. And if that's the case, one would indicate via a plus sign that that would be the case for each mechanism. No impact, meaning that the mechanism does not seem to impact achievement of this outcome one way or another. It's neutral, it's indifferent. And that a 0 would represent that conclusion. And then no, the mechanism disincentivizes achievement of the outcome in question. And a minus sign would suffice to indicate that conclusion. And then there is space here on the template for the parties to include discussion as to why that conclusion was reached, as well as other issues for attention. Perhaps your conclusion was no impact, 0 for the particular outcome you're looking at, but maybe there are some other things hanging out there that deserve mention, or just highlighting interdependencies between this particular mechanism and others. It's meant to capture a variety of thoughts as going through this. The next step, so this just shows a fuller the regulatory mechanisms are listed down the left-hand side of this matrix. The second column here allows for description of these mechanisms, and the assessment template that's attached to the staff report, in fact, has those descriptions filled in for the parties. And as I mentioned, for each, you would simply methodically go through and assign a score, plus, 0, or minus, include relevant discussion, and highlight any issues for attention. Having gone through those mechanisms, at the end of the template, there's sort of an overarching question that's asked of the individual conducting it, and it's sort of this. I'll read it directly. So overall, does the existing regulatory framework sufficiently support achievement of this outcome? So, having gone through each mechanism individually, what's the net effect, and what's the net impact overall? And again, yes, incents achievement, no impact, or no, disincentivizes achievement. And again, there's an opportunity and space for discussion, recommendations, observations, and the like. Yes?
Adding up the yeses, is that what you're doing? Not necessarily.
No, I think, no, so this is a good question and a good opportunity to provide some clarity there. Perhaps I'll just hold that question for one moment and address it in a second. I just wanted to highlight the final portion of the template, and then I'll address how staff or how these may be viewed. Finally, kind of step 3, and I mentioned this earlier, encourage to identify any sort of data, trends, any quantitative information that may help support the conclusions that were drawn, earlier on in this template, or other pertinent information that may be critical to include. So again, what we're suggesting to the parties is that they set forth their top 5 priority outcomes, and offering that they can conduct an assessment on each of those 5. And this should help provide an informed conclusion as to whether overall the existing regulatory framework adequately supports achievement of each of these 5 prioritized outcomes. And again, highlighting where applicable, where appropriate, citations to data and trends is always welcome. Now, Ron, to your question, the question was, how might these templates be utilized? Are we simply, adding up the scores here? How many pluses? How many zeros? How many minuses? And the answer is simply is no. This is intended to be a high-level qualitative assessment, and while there are, ways in which we might, get a larger picture of how all the parties are thinking about individual mechanisms, there's not a mechanical or sort of scientific. This is more of an art than a science as to, how we may elicit sort of conclusions about how the existing framework is working well or perhaps not so well as compared to specific regulatory outcomes.
I wasn't arguing for that. I
Sure.
just wanted to know that.
No, it's helpful to be able to clarify that. And so this is, again, more of an exercise in examining individual mechanisms against outcomes, and how well or perhaps not so well those mechanisms are helping drive achievement of the outcome to be assessed. And it can help just going through this process, having done it ourselves, just to make sure that we wouldn't subject you to anything that we haven't gone through and wrestled with ourselves. It can really help highlight some of the intricacies and interdependencies of particular regulatory mechanisms, and may help elucidate some conclusions in that regard. So with that, hopefully most of that was clear, but I wanted to allow for some clarifying questions or any other.
And we'll just maybe take a couple minutes on clarifying questions, and others can be taken up afterwards. But
so I was wondering some guidance maybe on how the parties can pick their top priority outcomes. I mean, do you want every single party to prioritize the affordability, fundamental outcome, or do we have latitude to maybe pick priority outcomes that maybe are newer and where we could see more, for example, more progress or more value from a PBR from a PBR approach?
Yeah, thank you. So the simple answer is, I think there's great deference given to the parties as to how they best think to approach this exercise. I think it's also helpful to hold in mind the direction that we're moving toward in terms of step 3. So, of course, here we are in step 2, conducting a regulatory assessment. The idea with this assessment is to kind of have a high-level qualitative look at what's in place now and how that or whether that sufficiently supports the regulatory outcomes that we care most about. And what we're looking to move towards is a more distilled set of regulatory outcomes that we can then, in step 3, begin to categorize across the 3 major categories of regulatory mechanisms we've identified early in this process, so that those being revenue adjustment mechanisms, performance incentive mechanisms, and other regulatory tools to help drive achievement of these outcomes. So if a party were to believe that, yes, in fact, affordability or reliability is a very important goal, but that particular party thinks that there needs to be more focus on some newer emergent regulatory goals or outcomes, rather. Don't mean to conflate the 2 terms. I think it would be appropriate to focus on those that particular party wants to dive more into. Hope that helps.
maybe time for one more question, and then we want to give you the opportunity to start to play with this approach.
Yeah, from looking at the first round of briefs, I expect there will be a lot of diversity among the parties in what their top 5 priorities are. So you may get a lot of assessments of a lot of different priority outcomes. You may not get a lot of diversity of opinion about for a given priority outcome, how do the mechanisms work? And I mean, that may not be a bad thing, but it just seems like a fairly apparent likely outcome here.
No, I think that's a fair comment and a fair observation, and I think that's certainly a possible outcome here. Yeah.
I think Mike makes a really good point. Would it make, I mean, I don't know if this is possible or for the other stakeholders are interested in this, but would it make more sense for us all to do the same 5 and then to layer on top of that ones that we want to assess, thereby giving you and the commission some basis, baseline on the outcomes? I don't know. What does everybody else think?
Well, I'll just interject here and maybe clarify. This approach that Matt is describing is for your party briefs. So I don't know. Yeah, but we don't need to decide that now, would be my instruction. And so what 5 outcomes different parties choose is for the parties to choose.
Yeah, I don't think I need to add too much to that other than the intention here is not to be prescriptive around which 5 priority outcomes individual parties would select. I think the observation is an astute one to the extent that parties on their own accord would like to coalesce around certain sets of outcomes. I mean, that's certainly something parties could do.
I'm going to offer space for one more question because I didn't mean to cut you off, Rod, and then we'll move into the breakout groups.
Thanks. And Matt, I think it's just related to Mike's question as well, and what Chris added is, given that we're all going to be looking at our top 5 and our own prioritization, how do you plan to use that input to come up with your list that you want to inform step 3?
No, it's a good question and sort of not unlike my response to Ron. And this is not a mechanical or scientific approach, so it's hard to answer that necessarily until we see the full landscape as to what comes in. I think we'll be evaluating which outcomes parties seem to identify as those that rise to the top, and then begin to examine how those parties in turn view the existing regulatory mechanisms and their approach on that. And so hard to prejudge how exactly that will turn out, but a little bit of a qualitative evaluation of the parties' qualitative assessment. So I think that's the best way to describe it.
Okay. Thank you, Matt. Thanks for those questions. I'm going to now turn it over to Kara to set us up for the exercise for the next hour.
Okay, great. So as Dan foreshadowed a bit, we are now going to get the opportunity to work at a high level with this assessment template. So as a first step, I'm going to ask for everyone to stand up and move to a group of 4. And so there will be 2 groups at each of the tables. And I suggest that you find folks you normally do not work with. So once again, you're going to be wanting to form groups of 4. If we have an odd number, a group of 3 is okay. Yes, please, and you have a couple minutes to do that. Okay, everyone has their groups. Fantastic. Okay, so my colleague Sherry right now will be handing out an outcome to every group. How these outcomes were developed, these were outcomes that were either emphasized in the staff report or in party briefs. And we are going to do an assessment for each of these outcomes. You will also have the opportunity to choose another outcome. And this outcome does not need to be in the staff report. it could be something that you feel strongly about. And I want to remind everybody that you have copies of the staff report on your tables with the list of the outcomes and their descriptions. Okay, so each group will be doing an assessment for 2 outcomes, and we will give you flip chart templates to complete those assessments. Okay, and this is really a way to start discussing and thinking about how these mechanisms support the outcomes, and to prepare yourself for completing those party briefs. So this is what it's going to look like. Has everyone received an outcome? Okay. Okay, great. So this is what you're going to get. Each group is going to get 2 sets of templates. They are 2 pages, okay? And we're going to be asking ourselves the question, did the existing regulatory mechanisms sufficiently support the outcome? Okay, and so we have a list of mechanisms right here. Once again, the descriptions of these outcomes, if you don't remember, are in the staff report. Carl also will be floating around if you guys have questions on specific details of those outcomes. So you are first going to assess whether or not you're going to give each mechanism a plus, a 0, or a minus. And what those stand for, a plus is, yes, this mechanism incents achievement of this outcome. The 0 would be no impact. The mechanism does not seem to impact achievement of this outcome. Or a negative sign, which is no, the mechanism disincentivizes achievement of this outcome. Okay? So you can just write in there, you all have flip chart markers to use, either plus, 0, negative, okay? We also have a space on the flip chart template for justification and observations. And we ask that you write those on Post-its with your Sharpies, okay? And so this is gonna be a space similar to the assessment template Matt introduced for you to note any interdependencies. Perhaps you guys were deciding between a 0 and a positive. Why? What kind of observations came out in your discussions that you think are important to note for further consideration? So as you can see, we have the MYRP, the multi-year rate plan, the RAM cap, the revenue balancing account, the ECAC, and the PPAC, and the new ECRC, as well as a space for PIMS. So that would be the reliability and the call service PIMS, as well as the policy PIMS. And then we have a space for other. So if there is a mechanism not listed, this will be an opportunity for you to list that there, as well as space for an overall impact. So once again, as Matt described, that would be looking at the regulatory framework, looking at how these mechanisms work together. What is the overall, how does this framework overall sufficiently support this outcome or not, perhaps? Okay, are there questions? You're gonna have 40 minutes to do this. So I suggest 20 minutes on each outcome to really get into the discussions of what is happening, where are these incentives, and what are the how are they impacting the different regulatory outcomes. Mark.
Where we tabulate this stuff. I mean, do we each have a flip chart or?
Yes, you will. Just to repeat this, you guys, we will be handing out each group. Hold on, I want everyone to hear this. We will be going around and handing out each group 2 templates for you to complete. Okay? Are there any other questions? You pick your second outcome. And once again, this outcome does not need to be included in the staff report. And the descriptions of these outcomes are in the staff report as well. If you feel like another description is warranted, please feel free to write that on a Post-it and put it up there. This is really trying to capture your initial thoughts and to prepare yourself for completing those assessments for the party briefs. Did you have a question? For both outcomes, yeah. So I'm going to let you know the time. I suggest 20 minutes on each to give, a fair amount of time for both, and I will be reminding everybody of the time you guys have left as it goes down. All right, time is up, everyone. Thank you. That was great. There was lots of interesting discussions going on. What we're going to ask next in these last few minutes before lunch is that you, as a group, choose one of these outcomes. Yes, for those who only did one, there you go. And we are going to display them around the room. So you don't need to do it yourself. I just want you to mark your outcome with a star. Star the outcome. And please make sure that both of your template pages have your outcome listed on the top. Okay, and so what's going to happen is we are going to then display these around the room. And when we get back from lunch, we're going to have an opportunity to walk around and look at what other groups did. We are also going to ask you to choose one person from your group to stay with your assessment during this time to answer questions, explain perhaps any observations you had or why you chose a particular impact. And that will all happen after lunch. So before you leave, get with your group and star one outcome that you're going to want to display for the rest of the group, and we will collect the other outcomes. So don't worry, those won't be thrown away, but just one will be displayed. Are there questions? And once you've done that, you're free to go to lunch. We ask you to be back in 1 hour. That's going to be 1:30. You all know this area better than I do, so there's lots of lunch options. So we'll start back here at 1:30.
Okay, so thank you for that. These assessments will remain on the wall through the remainder of the day. And absolutely, if you're not already, if you would like to snap a photo of anything that you might want to bring back into your thinking in the couple weeks ahead, as you write your party briefs, that's certainly welcome. Staff will be taking these down at the end of the day just for consideration and further input and contemplation through the work ahead. Next, we have our panel to consider the perspectives of the investor community. So I think at this time I will invite our two panelists up to the front, and then I'll have a couple remarks from staff before we kick off the panel. But just to invite up Toby Shea and Mike Weinstein, if you'd like to sit at our grand panel table here at the front. So, Matt, I think I'll pass the mic to you to just give a couple remarks on why we're having this panel, and then I will moderate.
Yeah, thank you, Dan. Well, first I want to thank both Toby and Mike for flying all the way out here to be with us today. I was asked to just kind of table set or frame a little bit as to why we invited these gentlemen to share their perspectives with us today. I think for those that are in the room that recall from the initial workshop, I think it's fair to characterize there a lot of conversation around financial integrity concepts and financial integrity of the utility. And, there was a variety of perspectives being shared, utility, consumer advocate, other stakeholder groups. And it was observed that the financial community themselves perhaps weren't there to speak firsthand. So we reached out to both Toby and Mike, and they were gracious enough to take us up on our invitation to share with us a little bit about their perspectives. Toby from the debt side and Mike from the equity side as to, what do they think about? What do they look at when they evaluate a utility? And what do they think about perhaps at a high level around performance-based regulation writ large, some of the trends that are occurring in other jurisdictions as well. So with that, I'd like to welcome them both. And I think, Toby, you're up first. So if we could give them a welcome, and we'll go from there.
I can start this for you.
I'll just say to our panelists, also thank you for making the trip across the ocean to join us at this workshop. If you haven't picked up on it, we're pretty like casual and loose here, so without the formalities of a grand introduction, I would just invite you to make a couple introductory remarks for what you represent and what your experience is, but then we'd love to hear your presentations. And to the participants, there will be opportunity for Q&A following their remarks. So again, if as you're hearing what they have to say, take note of particular points that you may want to follow up with questions on.
I cover regulated and unregulated utilities in the U.S. Been doing this for, including project finance, about 20 years. So I've been around for a while. I cover Hawaii Electric, is by far the smallest utility that I cover. The next biggest one is probably like $20 billion or something, but I like Hawaii the best. Okay, so I'll go through my slides. You guys, this is something that I did for EEI last year, but I kind of modified to kind of talk about the situation in Hawaii. So a lot of it, if you went to EEI, you might have seen it. So the first thing is. Okay, so the general thesis here is that cost of service regulation, in the long run, is not there's some conflict with the way the industry is going in terms of energy efficiency and demand response, and the need to sometimes contract PPAs to build renewables. And the main problem that we see is that you really need to spend money to make money, and so there's constant incentive to want to put steel in the ground, and you look at the emerging kind of trend in technologies. We're talking about demand response and distributed generation. Those often don't require a lot of steel in the ground. And PPAs don't do that either. So this is broader for the industry. We see that commodity price has been falling over the past many years, and that gave room for capital expanding. So commodity prices have fallen by 5%, and capital expenditures have gone up by 4%. And this is great rate-based opportunity for utilities generally. That's not the case in Hawaii, but this is more of an industry trend. And as you can see here, utilities commodity cost is correlated with gas prices, and as gas prices have stabilized, we expect that there's going to be less room for Capex to grow. So. What can we do to resolve some of these issues? One thing that we find very interesting is what UK has done in terms of Rio. They really have kind of found a way to create a win-win situation for utilities, regulators, and ratepayers. And some of the concepts here you guys might be familiar with, but they really took the multi-year rate plan concept and expanded for 8 years. They don't differentiate between operating operating expenses and capex, and they have very strong performance and cost incentive mechanisms. And so, more broadly, how do we see performance-based rate making versus credit? We don't think that they're not necessarily negative. In fact, if you look at all the ones that are done, they're actually positively correlated with credit quality. So in the U.S., we mainly see trackers and riders, and some places have 4 test years, and we view them as positive for credit. And as in Hawaii, you guys have extensive recovery mechanisms, so we also see those as positive. But if you look at what Rio has in UK, we actually see that as even more positive than what we even see in the US. We think that the way they approach it, being extremely transparent, as something that was very desirable. So definitely a very rigorous PBR is not necessarily negative for credit. In fact, a lot of times positive. Now, the New York Rev, it really didn't affect credit because it didn't go. It had very little effect. It got a lot of publicity, but not much came out of it. So I think that's something that you want to think about. If you have a small initiative, you may end up with a lot of administrative burden, but you don't get much in the ways of results. So that's kind of my spiel. There we go.
All right. Well, thank you very much. So I'm Mike Weinstein. I work at Credit Suisse on the equity research side. So I have ratings on the stocks for various utilities. We don't rate Hawaiian Electric yet, but that day may be coming. I'm not allowed to say that it will, but it may be coming. In the meantime, I think you'll find that Toby and I are in agreement about a lot of things. So. Okay, so first thing is I saw some interesting discussion about the financial health of the utility, and there's been some debate over whether that should be a guaranteed outcome. I think that it's safe to say that for investors don't require this to be a guaranteed outcome. It's better to be described probably as more of a conditional goal than an absolute goal, conditioned on management team actually executing their plan for growth and operation of the utility. All right, and that's perfectly okay. In fact, all that investors really require is a fair shake. So is an opportunity to earn a regulated return that is competitive with other possible investments that they might make in other utilities in other parts of the country. So, and in fact, that really is the bottom line. One other point I wanted to make is that there is an alignment between investor interest in the health of the customers and the regulators' interest in the health of the customers. Everybody wants their customers to be able to pay at the end of the day. That if investment pace is too fast, you can run your balance sheet too hot, and you can wind up with a requirement to have rate increases that are unsustainable and well above inflation. In those circumstances, that actually increases a lot of regulatory and political risk around being able to earn a reasonable return, and that can actually lower the stock price, raise the cost of capital. One of the places I wanted to emphasize, and I heard Arizona came up before, and I wanted to mention Arizona for a second. This is an example of where the utility and investors right now are very concerned about the goals that are being set by stakeholders in the state who want to achieve a 50% renewable goal by 2030. The concern is that the goals are being pushed too fast, and that the rates will be unaffordable in attaining that goal, specifically in Arizona, not necessarily in other states, but Arizona has some special circumstances around it because it has a nuclear power plant that is relatively new and also run efficiently, is a pretty large investment, as well as coal plants that have recent environmental controls. A lot of money was spent on that too. So there's concern over stranded assets. Now, that is not necessarily an issue here in Hawaii. Most of the plants here are pretty old, and so you don't really have that issue. And in some other states, there was the deregulation, and the nuclear power plants that were involved, like in Michigan, were already sold and are going to be shut down, and actually the regulators, there's no impact on customers. So that, in those circumstances, it's not a problem. But it is important to recognize that sometimes the goals, what a customer wants, they may want renewables fast, or they may want some other thing, platform services, or whatever it is. That those goals have to also be considered alongside affordability, because customers also want their rates to be affordable. So there can be a conflict there that needs to be managed. Okay, so thoughts on capital formation. I thought the Ulupono initiatives submissions were very insightful. I thought I learned a few things reading them actually. They thought that not only supporting capital formation for the utility was important, but also for third-party companies, renewable companies, and other companies that are actually trying to build and attach to the system. That are, they need to raise capital too, and one of the ways they do that is with PPAs to the utility. So a healthy balance sheet from the utility is useful for third-party capital formation. My first thought on this is that the ability to impute the debt associated with PPAs or long-term leases or contracts into the regulated balance sheet, so that these contracts get equity support from investors, can lower the cost, keep the cost of capital low. If too many contracts are signed and too much of the utility is PPAs without having any recognition for that in the regulated structure, in the regulated balance sheet structure, then you could wind up with investors looking at that as a risk. So some jurisdictions already have that. Actually, Hawaii is pretty progressive in that sense. My understanding here is that the equity ratio is pretty high for the utility, and that's one of the reasons for that is to account for imputed debt from contracts. So that's actually, you're already in the right direction, as far as I can tell. But other states that are also doing that they're few and far between, actually. So Wisconsin does that, and California has a big study on the same subject. So on alternative revenue streams, this is referring mostly to like platform services. The idea that the utility of the future will be a management of a two-way digitalized, two-way flow distribution system that would operate similar to the way transmission systems do now, in that you'll have to balance distributed generation with distributed load over a local distribution system in the same way that a transmission system balances various large-scale power plants and load at the same time in cities. So to do that, the utilities at the retail level will have to start making the same types of controls possible. That's going to require major upgrades to distribution systems. At the local level, it's a lot of these systems are really not, it's a 19th century grid for most of the system, and it's one-way flow. It was really designed just to deliver power. So the idea that you have to do two-way flow and actually control nodes in 1,000 different nodes or 1 million different nodes is going to require sophisticated digital computer-controlled equipment, and it's a lot of investment that has to be made. So under platform services, also interconnection would be considered just a feature of that system, where it's a starting point. Obviously, the whole system is designed for distributed architecture, so it's not an add-on or an annoyance or something that has to be accommodated. Right? Interconnection has to be accommodated under the current system in order, while you're maintaining reliability of the existing grid. It can interfere with that if you're interconnecting too fast. Under this system, it would be designed from the get-go to handle large numbers of interconnections. So anyway, so this type of a structure seems like a good idea for a utility to work on. I mean, it's right up their alley, play right into their expertise. Now in New York, they have similar goals. The utility has incentives to start working on some of these initiatives on an experimental basis. It's still all, nobody really knows exactly what type of architecture will be the best, what type of technology will be the best, and there's a danger in leaping too fast with it, because then you could wind up spending a lot of money on the wrong technology too fast, too early. So it's an experimental program. For that reason, in New York, almost all of the REV incentives are actually incentives above the existing jurisdictional revenue requirement and above the ROE. So they help the utility actually achieve in excess of their authorized ROE if everything is going right. And I think that's appropriate. In fact, this is a major point I wanted to make, is that when programs are when you're trying something completely new and it's kind of experimental and nobody really knows what the future will exactly look like, the utility is in a great spot to be helping with that, especially with large capital investments over large areas. But I think it would be important to have at least the incentive skewed to the carrot and less to the stick. Once these programs become routine and it's an expected service of a utility, that platform services will be expected of them, then you can start treating it like every other part of the utility obligation to serve, and they become a mandatory part of revenue requirement, and can be it'd be more stick than carrot at that point, right? You want to make sure that they do that it becomes a minimum requirement and not an extra credit. We've, a lot was spoken today about the different regulatory mechanisms. I had a few points here, but actually Carl's done such a great job of addressing a lot of the points I wanted to make already. So, but the revenue balancing account, I thought that one of the statements that was in one of the reports was that there was under recovery, but I think Carl cleared that up and said that it is expected that the revenue balancing account anyway is supposed to true up on a more contemporaneous basis, so there's less regulatory lag associated with that. I will say that when I talk to a lot of investors about Hawaii, the main complaint is regulatory lag. All right, the ROEs here, the earned ROEs, there's too much of a gap between what's actually earned and the authorized numbers. So the authorized numbers are closer to about 9.5%. The actual earned is closer to 7.5 to 8, and that's a fairly large gap. That's actually larger than most other parts of the country, even New York. Even in New York, where the authorized is only 9, one of the lowest in the country, they are allowed to earn up to 9.5 before sharing, and they do. They earn 9.5. They do some of that is because of the PBR incentives they're allowed to earn. We'll look at that in a minute. But those incentives allow them to get up to that level. Investors like that. Investors like earning the authorized rate of return or higher, mainly because it gives the utility enough ammunition to provide investors with a combination of growth and dividend yield. If you have an ROE that's too low, they will not be able to grow without issuing stock. Issuing stock dilutes the shares, dilutes the earnings, and eventually increases the cost of capital by lowering the target price for the stock. This is just to show you quickly how I value a stock and how most of Wall Street does it. For the utilities, it's all done on PE for the most part for regulated utility. PE is price to earnings ratio. So if the current price is 85, the actual market price, and they're earning, let's say, $5 a share in 2020, we use a future year as a proxy for future growth. Then we multiply it times the average multiple if we think it's an average company. That might be 19, and come up with a target price. The target price represents some upside to that current price, and then we add the dividend yield to it to get a total return. What I do is I just rank all those total returns next to each other, and the biggest ones are the buys, and the smallest ones are the sells, and it's really that simple. Now, if you have a company that let's say you don't want any growth at all. Let's say you think the utility shouldn't be growing, for argument's sake, let's say generation, and let's say you think that T&D should not be a grower. We've seen a lot of arguments against too much Capex, that utilities need Capex to grow, and that growth is the main engine, and that this needs to be watched and curtailed. If a utility does not grow, if the earnings aren't growing over time, then you're going to have to beef up the dividend yield to make it attractive. If it really is truly a mature industry with a mature company and they are not growing, then that dividend yield is going to have to be close to that 10% level, close to the ROE levels, right? So in order to make it competitive with other investments. Otherwise, investors want a combination of growth and yield. So in New York specifically, as Toby pointed out, it's a relatively new, REV is a relatively new docket, and the incentives there, the incentive programs are pretty new, and things are pretty small to start off with. So it's not really having much of an impact yet. There is I think there's probably some hope that maybe later on, the next decade, these numbers will be more meaningful as the programs start to develop. But just to give you an idea of what's going on, they're allowed to collect under the current 3-year rate plan. They have incentives allowed that are of $18 million in the first year, $48 million, and then $70 million in the third year. Compared to that, they're only earning 13, 15, and 22 respectively. So it's a small portion of it. Nevertheless, that's all above the jurisdictional revenue requirement. So this is all contributing to getting above the ROE. So that's all basically gravy. So I would take the 22 million and then in year 19, proxy that for 2020. It's about 6 cents of EPS. That's multiplied times a 18 or 19 average PE, let's say, or a 16 PE for an electric utility, and that comes out to about $1 a share. So, Con Ed's price, our target price is 74, so $1.74 is about a 1% impact. So if they got rid of Rev tomorrow, I would subtract that $1 and the stock would go down 1% exactly because that's exactly what I said. So. All right. And I put in a list of the outcome-based energy adjustment or energy adjustment mechanisms that they have. They're very similar to the things we were considering here today. And I think you'll all find the New York Rev docket to be very instructive as you move forward. This is just about regulatory lag, just another slide about it. And there's a difference between lag and drag. Lag is is caused by a time delay, right? So if you make an investment, there's a 6-month or a 1-year time delay that creates a gap in the earned ROE from the authorized. Drag would be more about things that are not being recovered. So disallowances, there are some expected things like management incentive compensation. That should be borne by the shareholders, not by the customers. So that does cause some ROE lag because it's an expense. But that's expected, and usually management teams make up for that with cost cuts or some other mechanism, maybe even PBR, right? And yep, that's what this slide says. PBR can be a way to mitigate any kind of regulatory lag or drag on the system. This is another slide. Just bear with me for one more minute, and I'll be finished. But one of the things I've noticed is that when a utility cuts costs by $1, that can help finance $7 to $8 of additional capital spending, even at a 21% tax rate. Forgive me for the use of a 35% here, but it's about 7 to 8 to 1. So in other words, $1 can support the interest expense and the ROE on a $7 to $8 investment. So what some utilities have done is, in order to grow their earnings, have been cutting costs using that to help fund additional Capex spending, and Capex grows the earnings for the investor. One of the most successful companies at doing this is CMS Energy in Michigan. They have a pretty consistent 1.5 to 2% cuts a year in cost cuts. A lot of that is driven actually by switching people off defined benefit pension plans to go into 401k. For another day, we can argue about the societal impact of that, but that is a successful way for them to cut costs for the next 15 to 20 years. And they are using that to fund a capital program of almost $50 billion over the next 20 years that will help grow earnings with, as far as we can tell, there's no equity issuances required, no dilution. That's a fantastic place for investors to be. So one of my pet theories is that over the next 10 to 20 years, a lot of the utilities will start to emulate Xcel Energy in Minnesota and Colorado and their Steel for Fuel program, which is the idea that renewables, more renewables on a utility scale system, managed on a utility system, can eliminate the fuel charge that is associated now with fossil fuel generation. Use that, fuel charges are a pass-through item, as we know, and nobody makes a profit at the utility. Those profits are actually made at the driller or at the coal miner level. But if you, with renewables, all those fuel charges can be converted to 7 to 8 times and put into Capex for new renewables. So you can use the reduced fuel to pay for the renewables. The renewables actually, all of that money becomes, instead of a pass-through, it becomes actual earnings capable, right? It becomes an actual driver of earnings growth. So this is one of my theories for the next 20 years. This will drive the earnings growth of the utility industry for the next 20 years. This is more of a pitch to the commissioners, just to let them know that utility ROEs are rising in the industry. We are in a period of rising interest rates. All right. It hasn't been like that for a while. There is a persistent gap between ROEs and Treasury bond yields and even utility bond yields. That gap widened as rates came down, right? Because the utility ROEs kind of stayed around that 9 to 10% level, even as rates have gone to ultra low levels. So as rates start to come up again, you would expect that gap to kind of close. Basically, before ROEs rise, you'd expect some gap to close there first. Sort of a reversal of what just happened over the last 8 years. Anyway, that's all I've got. All right, so thank you very much.
Okay, thank you both. So we now have some time for some Q&A from the audience. Wow, hands went right up. So I had a few questions prepared myself. Maybe if you'll allow me, because I just can't help myself, I'd love to ask. I'll keep myself to 2 questions, then we'll take some questions from the audience. Because this is a rare, I think like everyone in this room, I feel this is a rare opportunity to get some of these perspectives, not necessarily perspectives that are normally brought into these types of proceedings and these discussions that many of us are in. I'll ask one question of each of you, and then we'll go to the audience. And I would invite both of you to respond, but the first question first is directed to you, Toby. I'm just curious, you make a point in one of your final slides about the REV in particular is not actually amounting to a lot yet, and it has had a lot of administrative burden as a downside. So maybe I'll pose perhaps the provocative question. Does that suggest that bigger, bolder efforts are encouraged that get beyond what the administrative burden may be entailed?
I mean, from a quitter's perspective, we just look at what the results are, right? But it's obvious to me that if you don't do much, you're not going to move the needle, and so I kind of think of it as a baby step, and you get baby results. I mean, you may not like to hear that, but that's how it come across to me.
Thank you. Any other thoughts from you, Mike, on that question?
So, I mean, is the administrative burden worth it, basically? Is that, yeah. I mean, the way I look at it is it's still, these are early days for performance-based rate making, full-blown PBR programs that are intended to transform the system. I mean, that's a pretty big haul. So I don't have a problem with going a little bit slower, at least in the beginning, just to figure out what's working, what's not working, and where the problems lie as we go forward. There aren't too many examples to even look at. I mean, you're a little bit behind New York, but not that far, and so you can watch New York's mistakes and see if you can learn from them. But yeah.
Okay, thank you. So then
I think part of it is not necessarily that you don't want to experiment, but is how you design each mechanism. If every mechanism covers, $2 million, that's a lot of mechanisms you got to come up with to create a difference. And I talked to a lot of utilities in New York, and one of the big complaints they have is that they say, we spend a lot of time working on all this mechanism. I mean, all this pilot programs and things like that, and they're not scalable. They're not really replicable. You can't just create replicate them across the utility and to other utilities. So it's not that I think you don't. I'm not suggesting that that it's a good idea to just start doing something totally different without testing it, but just I think it's the number of mechanisms that you're working with.
I mean, I would just add that, I mean, look, simplified structures are easier for investors to deal with and value. But having said that, I mean, look, anything that improves the ROE here and gets the lag, or helps remove the lag, is probably going to be appreciated.
Great. Thanks. All right, my other question would be a little bit in a different vein. First, I want to really express my sincere appreciation. I've said it, but really for making the trip out here, as well as for the attention you've given to this specific docket and clearly coming in very informed into this proceeding. But I note that this, from my experience, it's been very hard to engage with folks in the investor community in these types of discussions. I personally have done outreach at different times to invite into not necessarily docketed proceedings like this, but other workshops. And I'm just curious for what are your reflections on what is the best way for this community to engage and have a dialogue with folks in your seat, and how do you prefer that to happen, whether it's through some of the conventional mechanisms or inviting into workshops, or how do you view that engagement?
I mean, from my perspective, I mean, I love doing this. I mean, seriously, and the more interaction we have with you guys, the better. That only helps my research be more accurate. I can tell investors want to know what's going on. They want to know what you want, just to make the right decision. I mean, they're not, it's not, I would say investors don't really have a view on individual issues so much as they just want to know what you're going to do and what you want to do so that they can make the right investment choice. That's about it. But in terms of getting a hold of me, I mean, I think email is probably the best way to do it. I would love to bring investors out to Hawaii for a whole week of workshops and everything else. I think that would be a great idea. And maybe one day we'll figure out some way to have a conference out here or something. But I encourage you all to stay in touch through email or phone calls, either way.
Yeah, at Moody's, we actually encourage to reach out to regulators, and so we've been going to NARU conferences, and we want to hear from you guys on all these issues. So email me, phone me, whatever you like to do. You'll be amazed how happy to hear from you.
Cool. Thank you. I'll restrain myself now and invite questions from folks here. So it's at least 3 hands up. I'm going to try to also hear from folks that we haven't heard from in the morning.
Thank you. Mike Brosh for the Consumer Advocate. A couple of questions. I was intrigued by the reference to the distinction between lag and drag contributing to earned returns deviating from authorized returns, and wondered if you had a judgment as to how much of the HECO company's spread is attributable to drag versus lag, because there are significant costs incurred here that are not recoverable for rate-making purposes.
Well, as I said, I don't really cover the company yet, so I'm trying to keep the discussion a little more general. I'm sure that the company itself has an opinion about what's causing the lag or drag in their numbers. But one of the things I've heard so far today is that, as we were discussing before, there might be a half-year delay or half-year of rate-based lag in the major project incentive mechanism. And that might be like one thing that contributes. My impression so far is that it's a lot of little things all adding up. It's not any one single cause. I mean, it's something that probably needs to be worked on from a lot of different angles.
Should regulators be concerned with any remedy for the drag effect, or is that more management's responsibility?
Well, like I said, some of those drag issues, like compensation, are expected. That's with every company. That's no different. And there is a certain amount of structural drag that's present in every ROE. For disallowances that might occur, like for instance when they go through the RAM mechanism, or and then eventually get reviewed at some point in the future if they get disallowed. To whatever extent that becomes a problem, if there's a lot of projects that are being pushed in without through a mechanism that doesn't necessarily have a review right away, that could increase the risk to the investment, right, to the in total pile by the time the next rate case comes along. Also, I would say 3-year or longer periods between rate cases can increase not only the drag but also the risk that there's a lot of stuff to review when that rate case finally does come up. So attrition increases during the 3 years can help alleviate that. Right? If you have some kind of, not just one rate increase at the beginning, but maybe a multi-step to account for programs that are being implemented during those 3 years, that can help.
Yeah, I can say that, talk about that from a credit perspective. I mean, at the end of the day, we're looking for cash flow and measuring that against debt. So if you're, whether it's caused by drag or lag or authorized return on equity, whatever it is, but if the actual return on equity is low and it would translate into lower cash flow and lower cash flow to debt, then we're going to translate that to a low rating. That's just how we look at it. And so I think there are several factors that contribute to the low ROE that Hawaii Electric gets. But I think those factors matter to rating.
Okay, thanks. I'll take another question over here.
Yeah, this is for Mike. I think one way to sort of summarize a lot of what you said is that a utility stock functions a lot like a bond, with the dividend being the yield, et cetera. So from that perspective, it just seems to me that when you introduce any kind of new regulation, including performance-based any kind of rate making, that ought to, all else equal, push down the share price. And so because you're increasing the uncertainty around actually hitting it, and so therefore shouldn't every utility facing this not like it, absent the case where it just comes in the form of upside?
Well, okay, that last phrase was the key one, right? So, so far, at least in the New York example, it's considered additive, right? So all the PBR is mostly an incentive scheme, right, to help achieve ROEs. So it's really more on the skewed towards the positive. Sorry, it's more skewed towards the positive rather than being even symmetrical or negative. If it was all negative, if PBR was considered, in other words, let's say you lowered the jurisdictional revenue requirement by 100 million, and you replace that 100 million with 100 million of possible PBR incentives. Yeah, now the whole thing is negative. Okay, that's that you've just increased the risk of being able to earn the authorized return.
So then, from that perspective, I mean, what's in it for ratepayers? Just better services and stuff, or what?
Well, yeah, you're trying to incentivize transformation of the system to something completely new. So remember that's the whole idea of PBR is to look, let's face it. Under traditional regulation, management is making almost all the decisions. The only thing you're providing them is just the only thing you require of them is reliable electric service provided to all customers across their franchise jurisdiction. Right, their obligation to serve is achieved, and that's what they earn their money for. Under PBR, you have a whole slew of things that you're asking for. It's not just reliability anymore. Now it's increased renewables, it's platform distribution, it's interconnections, it's there's a million things, a million objectives, right, that we're considering today. And so you're much more, PBR allows the regulator to be much more involved in management's decision making, and is doing it with a bunch of carrots and sticks also, but I would just argue that at least in the beginning it should be more carrots as we feel our way through it, right, to figure out what works and what doesn't.
Toby, do you have any thoughts to add to that question?
Yeah, I think I think a lot of people aren't familiar with what's happening in UK with their real regulation. I mean, I look at it and I think it's very impressive. The companies are earning a great profit, and the cost is going down and reliability is going up. I mean, I know that their system is a lot simpler. It's just it's just wires, and they're not looking for higher renewable and all that kind of stuff. But still, I mean, they have a lot of innovative concepts that is really not being adopted in other jurisdictions. I know it's not easy, but at the same time, I think that's a great example on how things can be, a win-win for ratepayers and investors.
That also gets at your correlation point from your slides, that there was a correlation between credit quality and performance-based rate making. But I mean, I think you yourself must not know or which way that runs globally. It's just that there's a few examples. So maybe the sort of most capable utilities went first, who are also the most creditworthy, et cetera, and commissions wouldn't dare impose it on some utilities that they didn't have confidence could make the transition. And I mean, I'm not the only one who probably heard this from NextEra, that they were excited about being exposed to it in the UK and didn't want to have it here.
Okay.
That's a great point, yeah.
If you can respond, or there's another question here, and then I'm going to go to that side of the room. I haven't seen the hands go up, but I invite you if you have questions. I'll be there next.
Thank you. My background's in credit, but my question is actually for Michael. I'll leave Toby alone for now. I was intrigued by, you mentioned the CMS example, and I think Michigan's, it occurred to me, Michigan's an example of something that used to look like Hawaii in terms of constant under-earning, disallowances, et cetera, Wall Street considered a very poor jurisdiction, and overnight they transformed themselves. And I think you can make a case that to the previous question, it was a win-win for everybody. Can you recount for us what they did in Michigan that kind of turned that jurisdiction around and got the utilities thinking about cost cutting and earning that return and helping customers at the same time?
Yeah, I mean, both utilities are very well run in Michigan, DTE and CMS. CMS, I have an outperform rating on. DTE, more neutral. It's more a function of price than quality. But and it seems to me like if you look at Michigan over the last decade or so, there was a concern, especially out of the recession, I think, that businesses were fleeing the state for high electric costs, and that their business rates were too high, so that they tried to first thing they did is they tried to rebalance the C&I rate along with the residential rates and put more of that burden on the residential customers in order to keep businesses flowing into the state and keep business there. That actually did have a positive effect. They also had some experiment with partial deregulation where they had 10% of the load was able to shop at the C&I level. That, I think there's been some pullback from that going forward, that there's been concern that that deregulated portion created underinvestment in the generation system, that the 10% was orphaned basically and nobody's building for them. So there's concern over that. But the main thing is I think the state just wanted to attract more business and keep business in the state and keep, they wanted to make sure that, that the utilities, they wanted to make sure the utilities were able to provide service to attract business and keep business in Michigan. When I was at the neighborhood conference in Phoenix in July, Chairman Sari, I asked him a question about why in the DTE rate case, why there was a $10 million shortfall according to the company. What happened? Is there's usually you get nothing but great rate outcomes out of that jurisdiction, and he looked at me like I had just cursed his children. I mean they take a lot of pride. He takes a lot of pride in that the Michigan Commission maintains a very positive regulatory environment for investors in the utilities there, so that the utilities are well capitalized and are able to provide low rates. That's like a big deal. So, and maybe it might have to do with just trying to attract business and trying to attract heavy industry into the state.
Or any questions on this side? I know you have a question, Ron. We hear from Ron Binns a lot. I want to get to your question. I also want to make sure to offer other questions. We hear from Chris a lot. Any other quiet voices that might have a question? This is your opportunity. Okay, maybe I'm going to go back to, Chris, Ron, the mainlanders have all the questions here. All right, we'll come back around.
One quick point of information to start with. I agree with your analysis on Colorado. What you didn't say is that the wind that they're bringing in and the solar is on it's lower cost than the marginal cost of running the plants. So in Colorado, you build a gas plant and then you build a wind farm, and the two of them are cheaper than the gas plant by itself. It's a very strange thing to get your head around, but with wind at $17 a megawatt hour, all in cost, 25-year contract, you use it as much as you can, and then you use the gas for backup. The question I have is, both of you seem to posit that the pie is going to be the same size. Do either of you think that a change in the regulatory structure will actually induce efficiencies at the companies, or are they tapped out? Do you understand what my question is?
What do you mean by
Revenue pie?
Well, look at what happened to RPI -X in the UK. It drove all kinds of costs down for 20 years. Then they went to RIO, which is a variation on that. My question is, are you assuming implicitly in the discussion you've been getting that HECO will be no more or less efficient than it is efficient as a firm than it is today if you change the regulatory structure?
I think based on my experience in looking at UK, they have become more efficient. So even though their revenue pie shrunk, their profit actually increased. Yeah. So what's the assumption for Hawaii? Well, it depends on. I think.
For U.S. Electrics General, I mean, do you think they'll switch to? I'm an advocate of revenue cap regulation. Is a switch to that going to induce more firm efficiencies?
I think if you introduce UK style PBR, I think it will increase efficiency.
Yeah. I mean, that would seem to make sense. I mean, one of the things too is if you give the utilities the incentive to cut costs because they can plow those cost cuts into new capital spending programs, now you've really created a win-win-win situation. You've got lower rates for customers, at the same time you've got higher earnings growth. All of that is made possible in some part by the ability to cut costs and also the declining costs of renewables, which is, the solar industry is cutting, so same thing.
Okay. Chris, did you have a question?
Can't help myself. So I'll respectfully disagree with your position on Arizona, but we're here in Hawaii. So I am curious, though. You criticized California, our states, and Arizona for California's going to 100% renewables. Arizona may or may not go to 50%. You didn't seem to like that, but you do like Colorado's 57% renewables, which is what is being led by Excel, and you yourself thought it was terrific. Hawaii's going to 100%. So how do you assess that? You seem to have differing opinions about differing states' renewables goals. As an analyst, how do you assess that? And for the commissioners who are here in this state, how are they supposed to assess your assessment of that?
All fair disclosure, I have a outperform rating on Pinnacle West. Okay, and I've been advising investors to be buying that stock because I think that the 50% renewable goal is actually going to be beneficial for everybody, including utility investors. The utility makes it. I'm not going to assess whether they're right or wrong. Right? They make an argument that in Arizona specifically, you've got some very high cost assets that have already been paid for, invested in under a regulatory compact, right? So that what they'll say is that these the Palo Verde nuclear plant and the Four Corners power plant are going to be stranded assets by 2025 if you try to go to 50% renewables by 2030. Now, I understand the NRDC is coming out against that. A lot of people think there are groups that have said there's no problem here. All right. Without assessing who's right or who's wrong, investors are obviously very nervous about the idea that there might be $3.2 billion of stranded assets that need to be paid for, and who's going to pay for that in 2025, because the stock is trading at a 10% discount, and it's one of the reasons I like it. All right. So, those fears are out there, and, because it's an argument that's being had, people will hold back with their money. All right. Same thing in California. California, it's well known that rates are rising fast. Okay, and a lot of that is because of renewable goals that are very aggressive, and that may be what the people of California want. In fact, as far as I could tell, it is exactly what they want. Right. So, it's not necessarily. I wouldn't argue one way or another. If that's what people want. If people want to pay more for a premium product, that is absolutely their right to do that. Right. Yeah. Well, in Hawaii, you're starting off with one of the most expensive structures in the world, so it's a little easier to make the math pencil out here with almost any change, right? So it's really a different situation than California or Arizona.
Toby, do you have a response to this question as well?
Yeah, I totally agree with the Hawaii situation.
Can you please make sure to talk right in?
I totally agree that in Hawaii the renewables are cheaper than oil, so it's an easy decision. It's just a matter of how do you structure a good regulatory mechanism to encourage that process along. So that's what I would say.
Okay, thanks. Was there any other questions, Mark?
So there's a law here in the state of Hawaii that in the space of 2 years that
the regulatory commission is supposed to transition to a new regulatory system that breaks the link between rate base and revenue requirement using performance-based mechanisms. Yet the one state that is pretty well known for innovating in this area is the state of New York, but you just got done saying that it really didn't amount to that much in New York. So is there any state other than New York that is further down this road and gives this commission confidence that metrics is a feasible way to break the link between rate base and revenue?
I mean, New York is the furthest along right now. I mean, California, there's a lot of the renewable goals are just as aggressive, but in terms of PBR and basically Audrey Ziebel, before she left the commission to go to Australia, she was a big proponent of the rev docket and creating a grid of the future, a distribution grid of the future. And so her legacy is that New York is moving probably faster than anybody right now with trying to create performance-based incentives to make some of these changes. But outside of that, actually, I would say Hawaii is probably pushing forward faster than anybody too. So I mean, you guys are the tip of the spear, military term.
Mark, you wrote quite a bit about UK's regulatory process, right? So why are you looking only in the US, or wouldn't you just look, in UK?
Well, my question shouldn't perhaps have been limited to only the United States, but is it your view that it's the PIM part of Hawaiian regulation, of British regulation that's so important? I mean, they have 8-year plan terms. There's this one information quality incentive that is the biggest part of the money that's riding on PIMs, but that's just because the utilities have misrepresented their Capex intentions again and again. So is it your opinion that RIO is an example of moving greatly beyond cost-based regulation using PIMs?
Yeah, I think they are making a lot of progress. I wouldn't say everything is you can copy it, but I think their toe tax concept is sound. I think at the end of the day, regulators are always worried about companies gaming the system, over earning, which in UK that's being heavily discussed right now. But I think it's also important to look at the end result instead of just worrying about am I getting the if you're getting lower cost, more reliable service, and the question is, well, so if the utilities are actually earning good money, or more than what you think they should be earning, how important is that? I mean, that's something that regulators have to decide. But I always find that kind of odd. It's like, well, I think part of PBR is kind of focused on performance rather than just going back to the cost of service regulation, which just focus on cost and regulating profit.
Okay, I'm going to take maybe 2 more questions from the audience because I've seen 2 hands here, and then I'm going to offer if the commissioner has the last question, then we'll go to a break. Ray, did you have a question?
Yeah. Mike, a large part of the REV proceedings were predicated upon revenues being made up by platform services and various new services. And if I was being cynical, I might say that part of it was almost a plug to justify some of the costs. Now, given that some of these are currently being trialled within the regulated business and impacting the ROE, where traditionally utilities have not been very good at providing unregulated services and actually making money out of them, do you think that's a sustainable mechanism?
All right, so I mean, if I understand what you're saying is that should we be treating these as unregulated type investments for the ROE capability or ability to earn above an ROE, right? It's still, I mean, what I'm talking about here are relatively small programs. It's not like you're betting the house on anything, right? And also whether the utilities are not as good historically on this. That depends. Utilities historically got in trouble when they diversified into non-utility investments. They have a better track record when it comes to stuff that's directly related to their utility business. And in a lot of cases, they're the biggest expert on load profiles and how the system can best interoperate with something. But and in many cases, they also have the lowest cost of capital. The counterbalance to that is that you may want to have more third-party involvement, especially in competitive generation and other parts of the system, because you want to see how competition will lower prices or keep things in check, right? So you use one against the other, right? But I don't have a problem with the utilities taking part in some of this non-regulated, or treating it as a non-regulated business almost.
Kyle, do you have the last question?
I do. It's first of all, thank both of you for coming out and sharing kind of your perspectives. So I wanted to pick up a little bit of what Mark said to give it an edge, but first preface something. So, Mike, what you mentioned about a possible future pretty much sums up in what we just went through with the NextEra merger, which is, in fact, you can drop costs a lot, and if you decide to put a lot of capital costs back into renewables, you can increase the utility share rates, but drop the operating costs down and kind of square the circle. And that was actually discussed ad nauseum, and a lot of people in the room were here with that. So but you're prescient in that sense that is a solution. What the challenge I think that Hawaii faces is you look at the total electrical infrastructure Capex requirement, and you look at the financial strength of the incumbent utility. There is an interesting challenge here that the total amount of Capex may exceed a single company's ability to provide that Capex, which happens sometimes. And that because we're at the renewal point. So with that context, and part of the other point you're raising is if you make the incentives too small, they're only 1% of the total share price, they lots of pain for little management attention, frankly, in terms of actually moving behavior. So are there, in that sort of a context, are there solutions that come out that both preserve credit rating, provide enough incentives to actually move the needle, and recognize that this is actually a pretty big capital bill? It may not all be paid by the one party. But some parties will rely on them because they are the PPAs, and some parties may be the customers that don't at all. That might be the context that we're facing here, but that context may be true in other states if they push to very high levels of change. So just thoughts about the structural problem and possible solutions from a finance perspective, like what would feel like that's actually a good way to go. Although you mentioned one, obviously.
I think I haven't spent enough time thinking what could be a possible framework, but it just seems to me like if you have very little, many small mechanisms that amounts to a few $1 million, I just don't know how that's going to make a difference. I don't have an answer.
I would look at Duke Energy's current plan right now to get grid modernization riders in North Carolina and South Carolina. They have a $25 billion grid modernization plan. A lot of that, portion of that, $3 or $4 billion, is for undergrounding and storm hardening. They have a lot of requirements, right? And that's over a 10-year period. So in order to get that program implemented at a normal pace, I think that what they would like to see are riders attached to their rates, so that in between rate cases, they have pre-approval to spend a certain amount per year. Let's call it $500,000 or $500 million a year, and the investments that they would be doing are kind of pre-approved. If it's undergrounding or if it's just general replacing poles with metal poles or whatever it is, those programs are pre-approved, just like pipeline replacement. And they're done with contemporaneous or very, very quick recovery mechanisms in rates. The revenues are actually following and tracking the investments so that the regulatory lag is minimized. And also the uncertainty is minimized.
Modernization or resilience.
Yeah, yeah. I mean, that's something to consider. I don't think you guys have that here. So, right. But I mean, but riders would be something to consider. And you know, they have riders in Indiana for transmission, and they, you know, basically their plan is to get them in all jurisdictions, all 10 jurisdictions. So they, you know, they've got a lot of work cut out for them, but and some of these things will require legislative support. So like in North Carolina, they're waiting for the state legislature to weigh in next year, and then they'll go to the regulators and probably get this approved. But that's my opinion. All right, that's why I have an outperform rating on that stock.
Thank you. Just before we let you off the stage, I want to invite Commissioner Griffin if you had a last question for these panelists.
Sure. First, I want to thank both of you immensely. I think this has been very valuable for everyone here. I think I just want to, it's really a question posed to Toby, but invite both of you. If I were to broadly characterize your presentation, maybe the message I heard was that you see greater risk in continuing with the status quo, traditional cost of service regulation versus a move to, at least, you know, you kind of advocated for the Rio type model. Is that a fair, broad assessment?
I wouldn't say I'm advocating Rio, but yes, I think especially as you move towards more energy efficiency, DER, demand response kind of, and PPAs, the traditional model is cost of service model is really not suitable, and I think Hawaii is at the forefront compared to the rest of the country in terms of this kind of development, and unfortunately there are many other examples because you're actually the first one to go down that road, and yes, I think by not changing you're taking a bigger risk than if you do. Now, I mean, how you modify things, you know, is depending on what you modify to. I mean, you can have different kinds of risk, but there is a lot of risk in not doing something.
Yeah, I mean, the Rio mechanism too is similar to the RSC mechanisms that some of the gas utilities have for pipeline replacement, and just like you look at Alabama, Mississippi, some of the southern states have these RSC type regulation systems that they've implemented with the gas utilities, where rates are set. There's a beginning baseline rate case that sets rates, and then they're just increase it for inflation. Very similar to Rio. And what I've seen there is those utilities are, investors love that. They love that. They love being able to have cost cutting fall right to the bottom line. And as you know, it's just a different investment environment around them. I will say that some of the gas utilities down there, like Alagasco and a few others, they do have very high equity ratios. They've been highly equitized over time because the retained earnings have been just accumulating inside their balance sheet, and nobody's looking at that anymore. It's not a metric that's regulated. So it's just something to consider. There are pluses and minuses to all that. And I don't know how that's fallen out in the UK in terms of what their balance sheets look like, but I suspect it's something similar.
Yeah. It has been good, but recently there's a lot of noise.
Okay, thank you. Let's give a round of applause for these panelists. Thank you very much. We will now take a 10-minute break, following which we'll have party presentations. So if you are one of those presenters, this is your 10-minute warning. And then we have one or two activities to close the day after that. So last break before we run until 5 p.m.